started. I've got a tremendous amount of information to cover, short amount of time to do it. So listen, I got to warn you in advance. I can get to ranting and raving a little bit, and I'm going to get downright evangelical here on a certain strategy. So you'll just have to forgive me. When you find something that works pretty good, you can end up getting kind of enthusiastic about it. So this is a picture of me. I'm I started a company called Cashflow Heaven Publishing, and we published several different trading letters, and I'm very proud of all of them. And we publish our track records for the public to see. I think that's really important for you to be able to see what you're getting into before you get into it. But the one that I actually write myself personally is the strategy that I'm going to be talking to you about today, and it's enormously effective. And I just want to kind of show you the details of it, how to do it, how to get into it. So what this particular webinar is about, and what we're going to talk about, is how to retire within 5 years on $13,000 per month tax-free. So that's a really, really specific goal. And if we're going to do that, I don't know if you set a lot of goals in your life, if you're used to kind of putting a plan together and making things happen, but a really good approach to doing that is start with the end game in mind. Start with what you want to accomplish. In this particular case, we want a $13,000 per month income coming in every month that we can depend on, and that we can use that money for retirement to fuel our lifestyle, to not have to work. And in addition to that, we want that income to be tax-free. So that's our goal. That's what we're going to try and accomplish. So a really kind of a cool way to accomplish a task like that, or something that you set before you, is to work backwards to where you are right now and figure out what steps you need to take to get there. So that's exactly what we're going to do. And the good news, before we really get into the details, I want to let you know is this is something that anybody can do that's listening right now. You don't have to be a multimillionaire. We're going to actually take a look at the numbers and how much money you do need. And it's going to get kind of interesting here. But first of all, we need a really good plan. And we've talked about that. And it needs to be safe. We don't need any big giant steps backwards halfway through it. And it needs to work. So 13,000 per month is a pretty tall order. So how do we do that? How do we accomplish that? So what do the professional financial advisors say we need? So if you've gone in and maybe you've got a professional financial advisor, or you've gone in and you and your wife or your husband have gone in and talked to somebody, and they kind of line you out with this plan, and it can be a little bit disturbing, what they talk about. So if you haven't been, this is something that typically you might, this is how they might approach it. So if you're looking for $13,000 a month, if you multiply that by 12, that's $156,000 per year. So I've got some numbers down at the bottom of this particular slide. So if you just follow along with me. So we're trying to bring in $156,000 a year from our trading account, or through investing in some way. So if you were to go the really safe route, and you buy a 10-year treasury bond, a 10-year debt instrument, that fluctuates between about 2 and 3% right now, but let's just say right now it's paying about 2.7%. So if you want that $156,000, you're going to need over $5.7 million. And if you've got $5.7 million in the bank right now earning interest, I take my hat off to you. That's wonderful. I don't know where everybody's at here that's watching, but I'm just assuming that there's some of us in the room that don't have $5.7 million. I'm just thinking that might be the case. So let's say we need to go out and get a little bit of a higher rate of return. So we're looking for maybe some dividend stocks, some higher paying instruments, and say you're pretty good at this and you get 5% per year, which is, a dividend stock, a typical dividend stock pays 2 or 3%. A really good dividend stock pays about 5%. And for that, you're just going to need in excess of $3 million. So once again, if you've got $3 million in your investment account, I take my hat off to you. I salute you. I think that's fantastic. You've obviously, done some good things in your life. That doesn't mean that you can't use a better way to make money, though. So this information is for all of us. But this is kind of typical returns right now. We're in kind of a zero interest rate world. As we know, if you've been following the news, Mario Draghi over there at the ECB had interest rates. They're now negative for the banks to keep their money with the ECB. So we're actually in a 0 to negative interest rate world. So getting 2.7 to 5% on your money is considered actually good right now. But we need to get substantially better than conventional returns for most of us if we're going to have $13,000 per month coming in tax-free. So I'm just saying that we could do better. So that's really what this webinar is about. And our plan needs to be safe and it needs to work. In the world of investments, there's always uncertainty. There's always risk in every investment. There's even risk in keeping your money in the bank and keeping it in cash in your mattress. And I caught that mattress comment down here. So, and mattresses are not a bad place to keep your money sometimes. But even in that situation, through inflation, our money is losing its buying power. So there's risk in just about everything. And I think the earlier you embrace that, the better. And it's just about managing risk. So if you're already trading, if you're already into futures or options or any leverage instruments or even in the markets at all, you're already a little bit familiar with risk and managing that. But this plan for our retirement money, we really want that to be, have a pretty relatively low risk and a relatively high degree of success. So this particular plan has a mathematical probability of success in the 85 to 90% range. So in thinking about all the investing you've ever done, would that be at the high end of your probability? And probably it would be, particularly if you typically trade leveraged instruments. So 85 to 90% probability of winning is a very high probability. And we're basing that expectation on the Black Scholes pricing model, which won the Nobel Prize for Economics in 1997. And this is for the options pricing model. And if you're familiar with Fisher Black, Myron Scholes, and Robert Merton, these are the mathematicians that came up with that model, and they actually enabled the modern options market as we know it today. So the CBOE, the Chicago Board Options Exchange, was formed in 1973. And before that, they didn't have a really good way to price options, and now they do. And this formula, the Black Scholes model, the original model, has since been modified a little bit and improved a little bit. But it's amazing how efficiently these options are priced for both buyers and sellers. So we're using a strategy that takes advantage of this Nobel Prize winning Black Scholes pricing model. This strategy is based on selling options instead of buying them. There's some really good reasons for that. The main reason it's important is you have a much, much higher chance of winning. So this is for you options traders out there, but if you've ever bought anything, if you're a futures trader or whatever, if you've ever bought anything that has an expiration date on it, and say we're just going to talk about options right here, if you bought an option that expired worthless, have you ever wondered where all that money goes? And when I first started trading options, I'd buy an option and I thought for sure the stock was going to go in a certain direction. And it didn't do what I thought it did, and the option went down in value, and it was worth so little I didn't get out of it, and then it eventually expired worthless. Well, I did that several times, and I started thinking to myself, does this money just all vanish into thin air? Does it just disappear? Is it destroyed? What happens to all this money? And I started thinking, what happens to everybody's money that buys options? Is there some great big pile of money accumulating somewhere? Is it just stacking up to the sky? And actually, there kind of is. It's estimated that just this year alone, over $1,116 billion worth of options will be traded. And that number, options volume, sort of goes up every year. People are really discovering options for hedging, for leverage, for a lot of different reasons. So it's also estimated that over 85% of those options will expire worthless. So that comes to approximately $949 billion worth of expiring premium. That's almost $1 trillion in expiring premium. So I think our picture, this mountain of money here, isn't nearly big enough if you think about that number. But I want you to ask yourself, what percentage of that $949 billion do you need to retire? And it's a pretty thin slice. An awful lot of options premium expires worthless, and it expires into somebody's account. And my proposal to you is that you be that somebody. So for the purpose of this webinar, we're targeting $13,000 per month. But as you'll see, that amount can be just the beginning. The strategy we'll use is called selling credit spreads. Now, if you think about, you know about selling credit spreads, I want you to stay tuned and stay focused because you're going to learn some new and interesting things about credit spreads that you may not know already. If you don't know about credit spreads, I'm really excited for you because you're going to learn an amazing way to make money here. And you know, just to clear the decks here and let you know, I've traded every possible strategy you can imagine. And you know, sometimes you have to get really good at money management, and you have to get really good at setting your stops to not have things really reverse on you. What I like about this strategy, and the reason I really like it for people that are thinking about getting retired, is it is so darn forgiving. So we're going to take a look at this. What is a credit spread? What the heck is a credit spread? A credit spread is simply selling an option. So options are kind of interesting. If you're not familiar with options, it's a little bit different than stock. They have some really cool attributes to them that, you know, once you figure them out, that really can work for you. So what we're going to do is we're going to sell an option. We don't own that option. We're just going to sell it. And then we're going to buy another option to hedge, to limit our losses if things go against us. So the option we are selling is more valuable than the one we are buying. So it creates a credit in our accounts. Now, a credit, if you're not familiar with this term, is simply money. It's cash that hits your account. And that money is yours to keep no matter what. So that premium that you're collecting, you can go out, you can pay for things, you can go out to dinner, you can pay your bills, you can put it back in the account and reinvest it. That's cash you get instantly. Now, here's how it works. This is a spread that we put on just not too long ago. And this happens to be on a stock. We do a lot of indices, but this is on Chipotle Mexican Grill. So as you can see, some news came out, so the stock was going down. You can see this phase here where it's going down for you chart readers in the crowd. And then they announced some news, and holy mackerel, it gapped straight up, comes back down, tests support a little bit, and then heads back. Now, which direction do you think this is going to go? Well, it's kind of looking like it's going up to sideways, or at least it looks like it's not going to go down too much. So it's about 549, 550, right in this range here. So we come way down here out of the money, below support. We sell a 515 put, and we buy a 510 put to hedge. What we sold is $1.55, if you can see that. That comes into our account right away. And that's per share, you know, so you times that by, you know, so many contracts, and you can start adding zeros to that. So you take in, you know, $1,500. We bought the put to hedge to protect ourselves at $1.05. That gives us a credit of 50 cents. So on 10 contracts, that's $500 hitting your account instantly. 20 contracts obviously is $1,000, and you can $1,000, and you can kind of, you know, extrapolate it up from there. But just in terms of what percentage we're getting, a 50-cent credit. Now, the most we can lose on this is the difference between the two spreads, this $5 right here, minus the 50 cents that we already took in. So the most we can lose, or another way to look at that is sort of our investment, our risk, is $4.50. So 50 cents divided by $4.50 is an 11% return. And this is for a pretty short period of time. We're putting on the spread here. This is when it expires right over here. We're looking only at about 8 trading days of time, not very much time. Now, another thing that we can do is, and that's probably got a pretty good chance of expiring worthless, this put spread down here, but we can also, really cool thing, we can go up here and we can sell a call spread. So in this case, we're selling the 570 call for 95 cents. We're buying the 575 call for 40 cents. And so that is 55 cents. And we're going to add that to our 50 cents and to get really increase our returns without having to come up with any more margin. The reason is because your broker knows that the stock can't close above the call spread and below the put spread at the same time. So they're just going to make us hold $5 in margin, but we've just taken in another nice chunk of premium. So, you know, you add these together, and let's just go back one. Let's go back one. $1.05 credit. So you add the 55-cent credit to the 50-cent credit. And if you go up here, I've done the math for us. That gives us $1.05 in credit divided by $3.95 in margin. That's our maximum risk. Comes to 26.5% return for just 8 trading days of time. Now, back in the old days, when people talked about credit spreads or selling bull put spreads or bear call spreads, you know, they're talking about, gosh, 5% per month, maybe 10% per month. And that's why I'm saying, if you're not familiar with credit spreads now, if you're not familiar with spreads ever since weeklies came along, it's a completely new ballgame. Excuse me. There is so much more money available, and you can pick your place on the time decay curve. And I will show that to you and why that's important. But if you're still a little unfamiliar with this, or you're kind of trying to follow along and see what we're doing, here's essentially what we're trying to do. This is the goal or the purpose of this little game that we're playing. We're trying to sell something that has value. So in this case, we're selling some calls and we're selling some puts. And in this particular case, we got $1.05 in credit. So for every 10 contracts, that's $1,050. You know, that's a nice chunk of money hitting your account. And what we're planning on is that the calls that we sold and the puts that we sold are going to expire worthless when expiration rolls around. In other words, we're playing a game where we want to sell just far enough away from the stock, the underlying, so that the stock never touches one of our sold strikes. And if we can do that, and we're pretty good at doing that, then we'll end up keeping all the money. So one of the really cool things about credit spreads that I tell people is that, you know, with an awful lot of trading, your timing and your direction and everything, your accuracy has to be pretty darn good. You got to kind of nail trades. You got to nail the direction. You got to determine what a stock is likely to do, when it's likely to do it. You know, you got to be pretty good at it. And there's very few trading strategies that are kind of like horseshoes and hand grenades, where close is good enough. We don't have to exactly nail the direction of this stock. The stock can go up a little bit. It can go down a little bit. It can go sideways. It can do quite a bit of unpredictable, weird stuff, and we'll still make money. And once you start trading this way and you realize that just the majority of the time you win, it is very, very easy to get used to. It is a really, really nice way to trade. And like I say, I've done every kind of trading you can imagine, and this is just something that I just gravitate to with my own money over and over again, because my account tends to build up. You know, you tend to make money. So it's one thing to create these spreads, but how do we know that our chances of winning are 85 to 90% or better? Oh, and by the way, take a look at the chart. This is what happened with this particular stock. So, you know, you had a big day in here, a big green bar. That looks kind of scary. It's getting kind of volatile, but then it just kind of settles down and trades sideways. And here it crosses the finish line right here, right in between our two spreads, our call spread up here and our put spread down here. And we kept the entire $1.05, which means we made about a 26, 27% return for 8 days of time. Now, for those of you that like to play fun financial games with your calculator, you know, get out whatever you have in your brokerage account and start getting a 20-something% return every 8 days to 2 weeks, and see what your account turns into in you know, just a few months. And if you really want to get excited, see what it turns into in a few years. So let's get back to our probabilities, though. That's really important, because if you're a trader and you've been around for a while, you're probably thinking to yourself, yeah, that all sounds really good. You know, all you guys talk a really good game, but you know, what happens when you lose money? What happens when your account goes against you? You know, what happens then? Well, that's why these probabilities are so important. So how do we know we have an 85 to 90% probability of winning? Well, one of the things about these spreads, one of the neat things about options, is they're based on a mathematical formula, which is the Black Scholes pricing model. And you see that pricing model right here. So whenever we sell an option, we can instantly see what the odds are that it will expire worthless. So this is the Thinkorswim platform. And Thinkorswim is my favorite brokerage. I know there's a lot of brokers out there now, but Thinkorswim gives you some really good analytical tools for options. And so if you have an account already, if you're thinking about opening an account, they have this box here. Do you see right here where it says layout? right here? Well, you go to this little yellow corner, this little arrow down here in the corner, and you click on that, and it gives you all these choices. So the choice that I want you to click on is implied volatility, probability, out of the money, and delta. So this one right here kind of tells you your probability of winning, because it says, what is the probability of this option being out of the money? So here we are. This is on the put side. So we sold the 515 puts and we bought the 510 puts. So you're always looking at the one you sold for your probability. This one right here, if you can see this, if you can get out your magnifying glass and see this, this has a 92.18% chance of expiring worthless. And we want it to expire worthless because we collected the cash for that. And when it expires worthless, that means we keep all the money and we have no more risk in that trade. And here, this particular trade, even though we made really great money on it, it was a fantastic return, it had a 92% chance of winning. So I think that's really, really cool. And I defy you to find a strategy that can make this kind of money with this kind of probability of winning. And here's the interesting thing, probabilities, even though we all think that we're smarter than the next guy and we think we're genius traders and we think we can win when everybody else is losing, and I think it's good to have a good self-image, and I think that's really cool. But the thing about probabilities is they kind of just end up playing out over the long run. I mean, you guys know, I mean, the market is so full of surprises. I mean, today we got a heck of a surprise. If you were short, you're probably still in a bad mood. So, you know, it was just a crazy day today. And I really like the idea of having a strategy that's pretty darn forgiving. So these probabilities do really play out over the long run, which makes for great odds. Plus, there are adjustments we can make to make the trades better when they go against us. So this is kind of a neat thing. It's not just your initial probability that's in your favor, but when something goes against you, when you just zigged when you should have zagged, and when the market's just acting crazy, and it's hard to predict, and it's approaching one of your spreads, and you never thought in a million years that it would do that, but it is, there is things that we can do. And those are called adjustments. And adjustments are really, really cool and really, really important. So I know it sounds kind of crazy, but I welcome the occasional trade that needs to be adjusted because it says two things. Number one is we're selling close enough to the underlying to have to adjust once in a while. And by the way, selling close means we're bringing in more money. And number two, we have the means to adjust our way out of almost any situation. It is really rare that you end up losing money. You might lose money on one trade, but you can adjust right out of it and roll it into another trade and end up making money on that one. So the cool thing about that is when you have these little tools in your arsenal and you really know what to do, when the market throws you curveballs, you know how to up on the bat or whatever and still hit those things, it makes you feel powerful and confident in what you're doing. So there's lots of different adjustments, and I've got a whole educational package that shows adjustments and how to do that. And you know, I want you to have really good information, so that's why I put all that together. But let me just show you one adjustment, just one simple adjustment that's kind of cool. So when you sell a call spread, at this chart on the left, when you sell a call spread and a put spread, that's called selling an iron condor. And here we did, the stock is right here. It's been going sideways for quite an amount of time. We're selling way above it. We're selling way below it. We have every confidence that this thing's just going to expire worthless and we're going to be fine. But here's what happens in the market. And if you guys have been watching the market for a while, you know how crazy the market can get and how many surprises you can get. So right after we put on this trade, what happens? The market absolutely crashes. It goes straight down and it immediately starts threatening our spread. We even get a gap down right here. So what do we do? What the heck do we do? If we know that if the stock goes past these two sold strikes, we're going to lose money, and we do not like losing money. So what the heck do we do? So what we do is we close this spread right here, the one that's threatened, and once we close it, we have no more risk in the trade. We don't have to worry about it, but it did cost us some money to close it. So we want to recover that money so we can still come out a winner on this deal. We can leave this one open because that one's just going to expire worthless. But we open a new call spread here and a new put spread here. So we're now bracketing the trade, the stock. So we're selling above it and below it. We brought in more money on this call spread, more money on this put spread, and we actually brought in more money than it cost us to close this put spread down here. So what looked like was going to turn into a loser actually ends up turning into a winner. So this is one of the things that you can do, but you can do other things too. You've got a lot of options with your options. So being able to adjust our positions and having the probabilities on our side is critical for the success of our plan, along with good chart rating and looking forward at the fundamentals driving the market. So for instance, you're kind of looking for low volatility here, so you might not want to sell a credit spread right before earnings come out on a stock, but maybe right after the earnings come out, that might be a really good time because the cat's out of the bag, but the volatility is still really high, so you can collect really good premium for selling something really far away. But chances are the stock has done most of what it's going to do. So you kind of got to plan when you sell these things. So we got a really good theory here. This is a really good plan. The probability's in our favor. The math is in our favor. The market's in our favor. Everything looks really good, but we want more than a theory. We want a proven plan, a proven path to follow. So has anybody actually done this with good success? Can we look at anybody that's actually done it? Well, of course, we've done it. And when we publish our and you can look at that. And I've been selling credit spreads actively since 2003. And I've actually written The Winning Secret, which is the newsletter for our credit spread service, since 2010. But is anyone else? In other words, is this method duplicatable? If there's other people who are doing it, can you do it possibly? And here's one of our subscribers, this handsome older gentleman here, Bob Malota. And here's an email I got from Bob. He says, as promised, here are my trading results for the year. So I emailed Bob and I said, hey, how have you been doing? What are your trading results? So he sent them back to me. He said, I very nearly had an undefeated season in my high probability credit spread trading this year. Unfortunately, I suffered my first loss for the year 1 week ago. My record so far for the year is 13 put ratio spreads, all done for a credit, 8 iron condors, 5 single credit spreads, one of which was the loss. He says that amounts to 25 wins and 1 loss. That's a 96% win ratio. I made a total of $19,126 and averaged $1,594 per month and averaged a return of 9.5% per month, including all commissions and losses. Okay, so here's what's going on here. Bob, I just absolutely love him. I love talking to him on the phone. I actually like all of our subscribers, even the grumpy ones. But here's what I'm noticing is there's a bunch of retired folks, mostly men. I know there's women doing this, but there's these retired guys all over the country that are sharp guys that just because they're retired doesn't mean they don't want to think anymore. So they're playing this game, and it's called credit spreads. And the reason they all kind of find this game is because you tend to win. So you try all this different stuff, and you're wanting to make your fortune in the markets, and sometimes it's like 1 step forward, 2 steps backwards. You get kind of frustrated, and then all of a sudden you find this method that wins, and you go, I'm sticking with this. So I've got all these old guys all around the country, and most of them are pretty darn smart. I'd have to say a lot of them are smarter than me. We got engineers and former accountants and scientists, and my cousin Ralph, who I'm going to introduce you to next, is actually a chemist, a retired chemist. And these guys know numbers and they know probabilities, so they just love this. And here's the cool thing. If you have an 80 to 90%, 85 to 90% probability of winning, most of the time you don't have to do anything. You put your feet on your desk, you watch your trades, you go golfing, you go spend time with your grandchildren, you do whatever. And by the way, I'm just saying what's typical. If you're 23 years old, you can do this too. If you're 33 years old, you can do this, and you should be doing this. I'm just kind of giving you a profile of a lot of guys I've run into that are our subscribers, and they're these really smart older guys that like seeing their account grow, and this is an incredible way to be able to do it. So most of the time you don't have to do a thing to adjust your trades. Once in a while you do. Once in a while you have to jump into action and do something. So another older guy that I talk to on the phone all the time who I absolutely love is my cousin Ralph. So this isn't really my cousin, this is my wife's cousin. And so by virtue of marriage, he's now in our family and I'm in his family. And After trading directional puts and calls with mixed luck, my cousin Ralph started trading this strategy. And he had such good results that this is all he does now. And so when he first started trading this, his wife was skeptical about him trading options. So he asked her, how about if I put an extra $1,000 a month in your purse? And his wife said, well, that'd be great if you can do that. So that's exactly what Ralph did. And so now he makes several $1,000s per month trading this strategy, and his wife isn't skeptical anymore. And I don't know for you guys that are married or for you gals that are married, it's not just you anymore. It's really kind of important to make your spouse happy. Kind of tends to make for a happier household and a happier life. And I just love this because some of us as traders, when we lose a lot of money, we really get scared to tell our spouse. It's not what they want to hear. So when you're making money, just kind of the opposite happens. It's actually kind of a cool thing. So those are regular guys making a good monthly income, but there's a woman named Karen that really took this method to a new level. She started trading with using this strategy, and she even used the Thinkorswim platform to do it. She was so successful, wealthy individuals and institutions, including her own former money manager, became one of her clients. They started giving her money to manage. Eventually, she was managing $95 million. And over the course of 3 years, she made $41 million using this strategy, and she's still trading today. Now, I'm going to turn you on to some YouTube videos where you can watch her and let her tell her story, and I really highly recommend that you listen to those and watch those because they're just super, super inspiring. And I've got nothing to do with these. I had nothing to do with this. Is something that Tasty Trade, Tom Sosnoff, in fact, I'll show you Tom. He's a character. He's got this beret on here. Tom Sosnoff was one of the founders of Thinkorswim, and so he has this web educational site called Tasty Trade. Recommend that you go there. Very cool. Tom's a really fun, cool guy. And to find that video, just Google Karen Super Trader Tasty Trade. And the first video is 24 minutes and talks about her making 41 million, and the second is 51 minutes and talks about making 105 million over a longer period of time, and they're both pretty inspirational. Now, I just want to qualify this, and that is she started off selling credit spreads. Now, credit spreads is where you sell an option, but you buy another option to hedge. Now, eventually she got enough money. Most of us can't do this and don't want to do this because the margin requirements are too big. But eventually she got enough money where she started selling options naked. And what that means is it's nothing risque. It's nothing, nothing particularly sexy, so don't get excited. But what selling naked is you just sell the option and you don't have any kind of a hedge or anything to protect it. And she can do that because she's got zillions of dollars and she probably has some kind of special dispensation on her margin. We can't do that. I don't recommend people doing that because there's too much risk involved. But the theory is exactly the same as what we're doing. We're selling an option that we intend on it becoming worthless. So, all the same stuff that made Karen her money, the time decay curve, all of that that's working for her can work for you selling credit spreads. So don't get hung up on that one little detail because I want you to get the big picture. So Karen talks about selling about 56 days of time for optimal returns, but that was before they made the changes in 2012 to weekly options. So I don't know if you're an options trader, if you're familiar with weeklies, but in the old days, they used to create a weekly on a Thursday and it would expire the following Friday. So the only time you could trade that weekly, buy or sell it, was in that about 1 week period of time. So in the spring of 2012, the changes that they made, which are really super cool, is on certain indices, like the SPY and the IWM and the XPX and the RUT and several others, they made it so there's options expiring every week that you can buy 3 weeks in advance or 2 weeks in advance or whenever you want to. So when I first started trading options back in the old days before they had weeklies, options expired on the third Friday of every month. And that's, whenever you bought or sold, that you knew that was your expiration date. So the cool thing about these weeklies is you can kind of pick where on the time decay curve you want to be. Now, the cool thing about time decay is that that's essentially our whole game plan here. We're selling something that we're planning on it expiring worthless. So the quicker we get across that finish line, the better. So let's just go on this time decay curve. So just so you can understand how time decay works. So let's say that 0 days right down here on this graph is expiration. And you know that the time value of that option is going to be absolutely 0 on that particular day. Usually that's a Friday. So if you go out 4 months, you see that the time decay curve is fairly flat. Time decay happens, but it's not super dramatic. If you go out 3 months, the time decay starts to steepen up a little bit. If you go out 2 months, it's pretty flat, and then it starts getting steeper as you're heading towards front month. So Karen and her team did a bunch of studies, and they like this 56 days. They used to back in the old days, when she did these interviews. And they like that because I think you're going from the second month out to the front month, and you can see how incredibly steep the time decay curve gets in that final 30 days. My goodness, look at all that time decay. So Karen is selling here. Okay, so that was before you could pick which weekly you wanted to sell. Now, because the things that we trade are expiring on almost any given Friday, we can pick when we want our expiration to be. So the reason you sell more time is to get more premium. We want more money coming into us, but we want the shortest amount of time possible because we want to get our money sooner, we want to turn our money sooner, and the less time you're out there, the less time you have for something bad to happen. So what we figured out is we did our own studies, and what we're selling is right about 2.5 weeks. So we sell right about 2.5 weeks of time, and here's what I want you to notice, is on the spreads that we put on, look at how fast the time decays. You are on absolutely the steepest part of that time decay curve. So every single day becomes significant. So if nothing else changes on that stock, or even better, the stock kind of goes away from your sold strike, boy, your spread can become, something that you took in really good money on can become worthless very, very quickly. So these changes that they made to the weeklies in 2012 have just been an absolute godsend to us. And I just have to say that trading options is getting, if you do it the right way, is just getting better and better and better. It's a better time now to trade this than we have ever seen in history. So we're taking what Karen has done as the inspiration for a new program designed to get anyone who follows it retired within 5 years. So these trades will be more conservative than our usual spread trades because we're willing to accept lower returns for a higher probability of winning. So our typical spreads yield anywhere from 15% to 30% every 2 weeks. But what if we went for much more safety and targeted just 10 to 20% every 2 weeks? Boy, when you start thinking about this and you start thinking about compounding, it's incredible how fast this can grow. So over the past 3 months, we've actually been averaging closer to 20% on our retirement trades. But we have to factor in occasional losses, like any trading. I mean, this totally stacks the deck in your favor, but I don't want to mislead anybody. You're going to have a few losses doing this. It's the nature of the game. If you didn't have losses, I don't think it would be a game. You wouldn't be able to get anybody else to play with you. So we got to let the other guy win once in a while. We also have to factor in commissions and the fact that we set aside money for buybacks and rollouts. But we're also averaging 2 weeks per trade instead of a month. So if we've been doing 20%, averaging about 20% every 2 weeks for the last several months, what can you really expect once you factor in all these things? You're going to have to factor in losses, commissions. I mean, what if we got 10% every 2 weeks? How would that be? Would you be happy with that, 10% every 2 weeks? Would that compound your money pretty quickly? Yeah, I think it would. Let's get even more conservative. What if we got just 5% every 2 weeks? Would that be a pretty phenomenal, pretty amazing, pretty incredible rate of return? Okay, let's even take that down even a little bit more. Let's make this super, super conservative. Let's say, even though through our best efforts and even though we're trying to do everything right and we're really good chart readers and everything, all we can manage is 5% per month. Now, I got to tell you, we've been doing better than that. You can go take a look at our track record. We've been doing really, really well. and we're planning on continuing that, let's just say for the sake of an argument, you know, maybe you're one of these guys that you think, yeah, it's been working good for everybody else, but the minute I get into it, you know, that's when it doesn't work anymore. So let's say all we can manage is 5% per month. What does that turn into? Well, getting 5% per month is still very impressive, especially when that money's compounded. So if we're going to really build up that account, we want to have as much of our money working for us as possible. Now, I'm just going to give you a little teaser because we're going to get to it here in a second. I'm going to show you what 5% per month turns into. I think we can do better than that together. I'm positive we can, and we have been doing better than that. But let's just keep it conservative. I'm going to show you what 5% turns into. You're going to be blown away, especially if you're one of these highly leveraged traders that's trying to make 100% by lunchtime, and you're not impressed with anything unless you can do that. So let's just talk about something really toned down here, something that you'd normally never even take a look at, 5% per month. But we're going to get to that in a second. So if we're going to really build up that account, we want to have as much of our money working for us as possible. In other words, we want to compound our returns in a tax-free environment to get all of our money working for us all the time. This is where the tax-free part of our little webinar comes in. This is so cool. Plus, wouldn't it be nice to be able to take that money out tax-free when it's time to live off of it in retirement? So not only can we build it all up tax-free, but then when we go to take it out and live on it, it's still tax-free. So that's like the best of both worlds. Of course it would be fantastic. We're going to put our money in a special account that can build to infinity without having to pay any tax on the profits ever. That special account is called a Roth IRA. So this isn't some crazy wacko weirdo strategy that's going to get you landed in jail. This is something that Congress put together, and some of you, I hope, already have a Roth IRA. But if you don't, this is the coolest thing that the government ever handed us. Because I don't know about you, but I absolutely hate paying taxes. You know, I was kind of ambivalent about the whole subject till I actually started making some money. If you make some pretty good money and you have to write that check every year or every quarter, it's really going to put you in a bad mood. So being able to make this money and see this money build up tax-free and retire on it tax-free is so incredibly cool. So let's just real quickly take a look at the characteristics of a Roth IRA if you're unfamiliar with these. So unlike a regular IRA, contributions are not tax deductible. So you can contribute up to 50, so this is after-tax income, but you know, think about it. Isn't that what you're trading with right now? I mean, all the money you put in your brokerage account to trade with is already after-tax income. So why don't you make it, you know, in an account that you'll never get taxed on it. You'll never get taxed on the profits. So you can contribute up to $5,500 per year under the age of 50 or $6,500 per year over the age of 50. And direct contributions to a Roth IRA may be withdrawn tax-free at any time. That's something a lot of people don't know. If you put your money into this Roth IRA, you can take it out and there's absolutely no penalty. You can't take out the profits without paying tax, but the government figures you already paid tax on it. Why should they tax you again? So you can take that money out anytime tax-free. You already paid taxes on it. So earnings may be withdrawn tax-free and penalty-free anytime after the age of 59 and a half. So I used to think 59 and a half was absolutely ancient. I don't think it's so ancient anymore. In fact, it's starting to look kind of youthful. So distributions from a Roth IRA do not increase adjusted gross income. So these earnings do not increase your tax bracket on your other income. So that's an incredible, fantastic thing. The Roth IRA does not require distributions based on age. So all other tax-deferred retirement plans require withdrawals by 70 and a half. Why does the government do that? Because they want you to withdraw that money from a regular IRA so they can tax you on it. They don't want you squirreling that money away forever. They want to get their taxes. With a Roth, they don't care. So you can let that thing build up as much as you want. So unlike distributions from a regular IRA, qualified Roth distributions do not affect the calculation of taxable Social Security benefits. That's incredible. You can still get your Social Security just like you would any other time, and that $13,000 a month does not affect what you get in Social Security. Unbelievably cool. Assets in a Roth IRA can be passed on to heirs. That's also unbelievably cool. Okay, so once again, of course, there's always going to be some little fly in the ointment. So here's the fly in the ointment. Is if you make over a certain amount of money, you do not qualify for a Roth. So single files can make up filers can make up to $110,000 a year to qualify for a full contribution, and $110,000 to $125,000 to be eligible for a partial contribution. And joint filers can make up to $173,000 a year to qualify for a full contribution, and can make between $173,000 and $183,000 to be eligible for a partial contribution. So here's the good news. If you're making substantially more than $183,000 or $125,000 or whatever the number happens to be, congratulations. Keep making that money and keep building it up. I'm behind you 100%. Unfortunately, you won't be able to take advantage of a Roth, but the good news is hopefully you'll have a lot of extra money to invest because you're making a lot. But if you're under these income requirements, boy, I really encourage you to trade inside of a Roth. Now, so the amazing thing about a Roth is that you can build up any amount of wealth in the account you want, and as long as the distributions are taken after the age of 59 and a half, the money you take is completely tax-free. So if we were averaging just 5% monthly return, and we're only using the money we can put in a Roth, what kind of an account can we build up in 5 years? And that is the big question. So if you're over the age of 50, you can put in $6,500. So we're just going to use that. If you're under the age of 50, that's even better news because you're $5,500. You've got more time to build that up. So you can make it really, really big. So we're going to use $6,500 per year contribution and take a look and see what it builds up to. So contribute $6,500 per year into a Roth IRA for 5 years at a 5% per month compounded return. And this is what your returns look like. So after year 1, you're getting $584 a month, which isn't too bad. And your account's up to about $11,600. After your second year, you're getting $1,632 per month. And I think that's more than what a greeter at Walmart is making, which some people could end up in their retirement years if they don't hear about this strategy. And your account's built up to $32,000. At year 3, you know, one of the coolest things about compounding is see how this curve is not in a straight line. It's sort of this exponential increase. At year 3, you're at $3,500 a month. You've got $70,000 in your account. Year 4, you're at around $6,900 per month, $138,000 in your account. And year 5, you're making just under $13,000 per month. You got $259,000 in your account. That's some pretty amazing math. That's some fun math. Now, that's pretty impressive, but since you never have to take the money out, it's possible to just keep on building it. So what do years 5 through 10 look like? It just gets crazy. I'm not even going to show them to you. Get out your calculator and take a look at it on your own. It can turn into well over $1 million. Well, actually, here it is right here. I am going to show it to you. So here's year 6. You know, you're approaching $500,000. Year 8, you're at $1.5 million. Year 9, you're close to $3 million. Year 10's $5 million. And, or excuse me, year 10, you're up over $9 million. Okay, so right now, you're probably thinking to yourself, you know what? Stop it with the pie in the sky, wild, crazy, never happen in a million years projections. I'm dealing in the real world. I want to know what I can really make. So, oh, and back to our 5-year plan, you know, it's $12,965 a month. Well, your very next month, you make $13,614 per month tax-free. So that's where that figure comes from for the title of our webinar. But you can see, boy, it could get a lot bigger than that. So, but before you say that's impossible, now I realize we don't live in the calculator world. We live in the real world. And in the real world, we won't get exactly 5% every month. Sometimes there's going to be setbacks, and sometimes we'll do better. I can tell you that we have been doing better. I can also tell you that I can guarantee you, because we live in the real world and it's the real stock market, you know, we'll get a crash at some point or something will happen, and you know, you'll have a month maybe that goes negative. We just don't have those. We don't seem to have negative months. I'm not saying we can't, but we seem to be making money every single month. But the point is, the probabilities say the plan will work, and it is working right now. Something I also want to point out is that when you look at those really big numbers that we looked at in those years 6 through 10, and it was getting up in the millions of dollars, Maybe you think that's not a reality or it's impossible or that could never happen to you, but I just want to point out that Karen has actually done it with numbers that are far, far bigger, $41 million in profits. I know when a guy like Tom Sosnoff, who started Thinkorswim and is a millionaire in his own right, he bows down to Karen. He says, oh my gosh, you're a goddess. How did you do this? I mean, this is incredible. Tell us. And when I see that kind of respect coming out of him, I know she's really doing it. He's got access to her bank accounts, her accounts at Thinkorswim. So there is big money to be made, but you can make the amount of money that's comfortable for you. So I opened a Roth IRA at Thinkorswim, and if you let them know you have options trading experience, they will let you sell credit spreads in your Roth IRA. And I'm doing it right now, and a bunch of our subscribers are doing it. And if you decide to come along and do this with me, I'll even set you up with an account at Thinkorswim with the inside track to discounted commissions. And that gives you a huge advantage with credit spreads because we're doing a lot of legs. And so we have an account rep there, and they know that our people trade a lot of contracts because of the nature of the strategy. And so they said that they will interview each one of our new people that comes on board, and they can probably beat those published rates pretty well. So we're doing 2 trades per week. The first is our usual more aggressive higher return credit spread. So you got an opportunity to do that. You can do that in a regular account if you want. But our second trade is a Roth retirement trade, and it will be a little lower return but safer. We'll be shooting for a 15 to 20% or better return with an 85 to 90% probability of winning. The 2 trades can be traded in 2 separate accounts, and as you've seen, the buildup over time can be pretty amazing. So I just got to tell you, this is a train you don't want to miss. I predict if you come on board and you do this with me, you might start off with a small amount of money, but there'll come a time when 80% of your trading capital is doing this strategy, and maybe 20% is still doing what you're doing now, if you enjoy the game of what you're doing and you like it. But your probabilities of winning are so high here, and those probabilities actually play out in the real world. Truly, on about 8 out of 10 trades, you just don't need to do anything to them. They just expire worthless. You keep all the money. The other 1 or 2 out of 10 trades, you're going to need to adjust them, but we have some good ways for doing that. So it's super important to me that you are successful with this. So I want to make sure you've got absolutely everything that you need. So to make sure you have a really good understanding of how the strategy works, you'll get a complete video presentation called How to Trade Credit Spreads for Fun and Profit. It shows you step-by-step how credit spreads work, even if you've never traded them before and don't know anything about them. This is a really, really neat video that just takes you by the hand and shows you what's what right from the very beginning. And it shows you why they work so well and how they can work for you. I've also put together this incredible educational package. You'll see how wide of a spread to sell, how much time to sell, what to do if the stock starts getting close to your spread, how many spreads to have on at one time, plus a big section on adjustments, which is what everybody always wants to know about, is how do I adjust a trade that's going against me? So you have everything you need to trade this strategy with confidence. I even want to show you what you'll be getting here. You'll get a 161-page downloadable ebook, complete with color graphs, charts, pictures, and everything you need. You get a 15-chapter video series so you can watch and learn. It's a really great way to learn because you're seeing it and hearing it. You get 14 separate audio files, completely different. You can listen to those while you're in your car, on your treadmill. Really good information. We've got archived webinars, and you have access to all new webinars for life as an owner of this package. I just got to tell you, back in the day, I was selling this package from the stage for $2,500 a pop, and we sold a ton of them. And there were times when I'd discount it and give them, I'd say I'll take half now and sell it to you for $1,250, and you can give me the rest out of your profits. But we sold a bunch of them, a bunch for $1,250, and I'd say it's better now because I've added some extra things. Here's some of what we've added. You'll get 3 videos that show you how to set up automatic orders with our favorite broker for spread trading, and that's Thinkorswim. And these are videos that will show you how to automate your trades so you don't have to constantly monitor them, providing peace of mind knowing you'll get out of a trade if you need to at the exact right time without having to watch your positions. And here's the actual service. Now, this is the subscription service. This is the one that I write every week. You get 2 high probability trades every week. You get a complete breakdown on the market, I'll show you exactly where to sell your spreads, exactly how to sell them for the possibility of maximum gains with minimum risk. I follow up on the trades every week. I'll never leave you hanging. I'll take you by the hand. We'll be doing this together. I give really good guidance. If there's an email that needs to go out in the middle of the week, I'll send one of those out. I want to make sure that you have the highest probability of winning. And this is what I'm doing with my own money. This isn't theoretical. I'm actually in these trades myself. Plus, as an extra bonus, you'll get a 10-module video course specifically on trading the weeklies. In the world of options, weeklies are the most exciting thing that's come along in the last 10 years. Everybody wants to learn about the weeklies. Everybody's constantly asking if they can buy this all by itself, this 10-module course on the weeklies. It's incredible information. I'm going to throw this into this package as a bonus. And to make sure you have everything going for you possible, you'll also get a special link to open an account at the best broker in existence for this strategy, and that's Thinkorswim. And once that account is open, we'll put you in touch with our special contact at TD Ameritrade, that's the parent company of Thinkorswim, to get you special commission rates set up just for this program. So I want you to come on board so we can trade this plan together, invest what you can, and prove to yourself how well this works, then watch your account build. If you don't know what it's like trading with 80 to 90% probabilities of winning, I really want you to get to know what that's all about, because you're going to like it. You're going to like winning, and you start expecting to win, and you get in the habit of winning, and it's great to see your account grow. So to get everything we've talked about and to put your feet firmly on the path towards a more generous and secure retirement, go to creditspreadswebinar.com. Now, I've got it. You can't hardly see this. It's all blue because it's a link. I hope maybe Raleigh or Yana or Morgan can put this out there for you to click on. I see they just did. The subscription service is normally $97 a month, and that's what we do charge for it. And the package, I've discounted it down to, we used to sell a lot of them for $1,250. On the website right now, you can buy it for $395, so that's just about $500 for both of those. Because I love Morgan's people, I love presenting on Trading Pub, I've got an even better deal than that. I've got a deal that you're going to really have to see. You get the whole educational package, you get everything that we talked about, plus you get the subscription, all for a really nice price. So I want you to go there, and we've got just a real short amount of time to answer questions. I'm sorry I wasn't able to answer questions during the webinar, but I'm so busy presenting I can't look down and type at the same time. So, I'm just gonna, here's Trader Doc. Is it realistic on the day you see the probability, no guarantee for tomorrow? That's the real truth. The rest about getting your money, that's not really a question. Okay. Joseph says your CMG Condor shows only a 55-cent credit. That was actually for the call spread, Joseph. Down on the put spread, we got another 50 cents, so that ended up being $1.05 for both sides. What else? I'm a good chart reader. Could you be successful with this? If you're a good chart reader and you're familiar with reading charts and technical analysis, you'll do even better on this. Chart reading and technical analysis will only help you. I know nothing about options. Can I do this strategy? You can, Steve, and I just want to bring up one more point that I didn't mention before. We've got really good customer support here. So the gals that answer the phones, I hate to say this, but they're smarter and better looking than I am. And one of them, Alicia, hired her a little while back. She's got a master's in finance. The gal's a genius, and I gotta say she's the most unlikely financial genius I've ever met. She's covered with tattoos. Her hair is all different colors. But she's a gorgeous gal, and she's incredibly smart. It's just a kind of an amazing combination. But if you call up on the phone and you talk to her, she knows the strategy inside and out. She knows about options, so she can give you some good help in addition to all the education. So you get a lot of support, you get a lot of education. We're just a phone call away. Any questions? If you guys already asked a question early on, you can ask it again, and I'll see it because I'm just kind of down at the bottom here. It says, wouldn't one loss wipe out the entire profits? That's a great question. No, it wouldn't, because you're not putting all your money into one trade, and we always get out before a maximum loss. Is this presentation recorded? Yes. One of the wonderful things Morgan does for his attendees is he always records them. What is the ongoing monthly cost after the initial enrollment? $97 a month. which is a drop in the bucket compared to what you're going to be making. The month I don't make you money is the month I want you to quit. And we're very, very confident that we're going to do you some good. What's the minimum account size? I like people to start with about $5,000. I think less than that, you can't really get on the trades the way that you'd like to. So I think that's kind of a minimum. You could do the $6,500 Roth account or the $5,500. You can obviously do more. I mean, if you've got more money, put more money in there. Like I say, but you got to follow my instructions. You know, put your stops in where they're supposed to, and don't call me up on the phone and say I didn't follow your instructions and I lost money. You know, I can only do what I can do. So I give you really good specific instructions. Great webinar, Peter. First, thank you, Charles. Gosh, we all need a pat on the back once in a while. I appreciate that. Can anyone do this if I never traded before? I think you can. We'll walk you through it. We got really good education. We'll get you squared away. I believe in education. What is the limited time extraordinary profits webinar special at $297? That's what this is. So even the way we discounted in the value we've got at $500, even though that's good, I want you guys to do a little better so you can get all the education. You can start off with your first month with a subscription for $297. It's like the best deal on the planet, so take advantage of it. Questions. Can we see your past performance? I don't know what we've got on there. We posted. We have several months back. I think the previous years we just deduct them because it takes up space. So, but the probabilities do play out over time. What you see is what we've been getting. What if you need to make an adjustment before the next newsletter? Do you send an email? Absolutely, I do, Brent. I never want to leave you hanging. I'll adjust trades out of my own account, and the minute I do that, I send out to you. In fact, I never adjust a trade in my own account without you getting the email first. I feel that that's unethical. So before I make an adjustment in my own account, I will send you an email to do so as well. Can you set your stop loss when you open the trade? Absolutely. You don't have to watch it every day. No, you do not. Can you get the subscription without the package? Yes, you can. You can subscribe for $97 a month, but if you go to get the package, then it's the full $395. If you get them both together is where you get this big discount. Let's see. Very interesting webinar. Thank you, Colin. I have a traditional IRA. Can Thinkorswim change it over to a Roth IRA? Yes, they can, Steve, but if you do that, and I've actually done that with my accounts, if you do that, if you switch a regular IRA to a Roth, they're going to make you pay the tax on everything in that IRA. And for me, it was worth it. I just paid the tax and said, that's cool, but from this point on, I'm going to have a tax-free build-up. So go ahead and go to creditspreadswebinar.com. And thank you for attending. Thank you for being here. I just so much appreciate that you have the wherewithal and the interest in your own success to watch. I know you guys watch a lot of great webinars. There's lots of good speakers. There's a lot of smart guys out there. I just want to show you something that works for 99% of us that don't have perfect timing in the market or don't get every single trade perfectly right. So thank you so much. I really hope you come on board. I want to make a believer out of you. I swear this is the best thing I've ever done in the trading world. You just win a lot more than you lose, and the bottom line is your account tends to grow instead of shrink, and I think that's what we all want. So thank you so much for being here, and thank you, Morgan, for having me. Thank you, Yana, for all your great support, and Raleigh, welcome aboard. It's good to have you here, and I appreciate having a chance to present to you.